watching Investor's Guide. Thank you for tuning in. Over the next half hour, we're going to try and work through what's happening in our market right now and in the general environment and figure out what you should be doing, if you should be doing anything at all, to invest your money. The fundamental aim, of course, is to invest for the long term and get rich. All of us want to retire with a lot of money in our bank accounts. We're going to start off by first telling you why you should never leave your money in a savings bank account. In our product review, we take a look at the Birla Sun Life Dynamic Bond Fund. I will tell you if you should be making any sort of lump sum investments at all. Let me welcome Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for tuning in. Once the temptations actually going through to the end of the year right now is to sort of revisit our portfolios and jiggle things around. A lot of times we'll have agents who show up and say this particular investment has passed its lock-in, so now you can move the money around, move it from point A to point B, and this is what we were talking about last week as well. When basically, when you take money out of your account and leave it out of an investment and leave it in your savings bank account, it's actually losing value. Would you recommend that anybody look at rejigging their portfolios or shuffling their money around on a regular basis? How often should we reevaluate our portfolios?
No, just because there is a financial year end, you should be rejigging your portfolio. I think don't entertain such ideas. That's first and foremost. If you are invested with a plan, the primary reason why you should be rejigging your portfolio is primarily two. You need the money, or your investments are not good. The reason why you bought them are no longer valid. Are the only two reasons. I don't think there is any third reason. I don't think one should be rejigging moving things around simply because somebody tells you that here you have a capital loss, here you have a capital gain, you can offset that. You can do a little bit of that, but that is meant for very sophisticated investors who are looking at their tax. If you are a trader and if you have generated a lot of short-term capital gains and if you have some short-term capital loss sitting elsewhere in your investment, you can sell, acknowledge that loss, and offset your gains and then buy those investments again. But this is not meant for ordinary, not ordinary investors who are trying to optimize and get focused on your goal, because the problem is once you do that, it gets hard for you to get back. So just remind yourself of the two reasons why when you should sell your investment. You need the money, or the investments are no longer good.
Right, remember, only sell your investments if you need the money or there is a reason why you know for sure that those investments are no longer good. Dhirendra, let's take a look at our first portfolio that's come in. A 43-year-old with the aim of child's education and own retirement, single earning member in the family, no loans. 43-year-old Aitava Joshi has written in from Pune. He would like to have some money in his account for his son's graduation fees of 50 lakh rupees in the next 5 years. He said he's considered inflation already. In the next 10 years, post his son's graduation, he'd like to have about 80 lakh or 1 crore rupees. And he thinks the money would be invested in all safe instruments so that he doesn't have to, worry about losing any of it. It would leave less savings for his retirement, he says. These are his financial details. He spends about 60,000 rupees a month and saves 70,000 rupees. Life insurance looked after. He also has a cover from the company that he works for. Medical insurance, he's also looked after right now. He has an emergency fund, so he's checkboxed all of those things. He owns a flat and he doesn't have a loan on it. And he also owns, a couple of four-wheelers. He has a car, and which are all loan-free, so he has no real worry on that as well. He has a PPF, which is 20% of his total savings. Tax-free bonds, 20% of the total savings. And he has fixed deposits, gold FTF, he says, and the LIC policy. After that, he has some mutual fund investments. Now, he seems to be a conservative investor there. He said very clearly that he doesn't want to risk any of this money, especially if it's for his son's education. Are you comfortable with his asset allocation? Do you think that's a good way to go?
No, I'm not very comfortable. But, I would not like to drive him to assume higher risk simply because I think assuming higher risk is not assuming great risk. But still, assuming we follow his path, I think he should have that money which he needs in the next 5 years for his child's education. It should be invested in a manner that, he doesn't have to worry about it. That return can also be optimized in some, either fixed, the way it is lying there, or By assuming a smaller, allocation, maybe 5 to 10% into equity, or maybe even a short-term debt fund or a medium-term debt fund, without assuming any great duration risk even in the fixed income market or among fixed income fund, that can optimize his return. Or the returns will be tax efficient. They will also be very liquid. Ultra conservative approach to these investments will be that the money which is unlikely to need or for consumption or spending in next 5, 7, 10 years, I think his retirement corpus definitely should be a reasonable part should be allocated to equity, simply because if he has 17 years to his retirement, not investing in equity is the risk, because coming times I visualize that our fixed income investments will not be able to beat inflation. So he might theoretically think that the investment is growing because of the interest accrual, but the worth of the money, the purchasing power of the money will be on a decline. So he will, 17 years from now when he retires, he will have less money, or his money can buy less stuff. So in that sense, optimizing return, beating inflation, or should be the primary objective of any investor, and more so for your long-term goals. Medium term, short term, you can ignore it because you need the money and you don't want to, and it should not be done. But this, particularly for his retirement, he must have some equity allocation, and he should understand that assuming risk in a manner that he's able to reduce the risk, assuming the volatility risk, and investing in a manner that he can de-risk himself from the big risk of equity. And there are only simple ways of it. Go with a conservative allocation, invest regularly, and make sure that this money you are unlikely to need for till your retirement, and don't invest any other money which you are likely to need in next 3, 4, 5 years into equity. So following these principles will be important. Not assuming equity exposure is a risk.
And of course, how sort of equity exposure should you be taking? Let's take a look at his mutual funds, Dhirendra. He has HDFC Top 200, Prudence, Reliance Equity, which is 5% of his savings. He says he's invested in direct investments. He's got 15% in direct equity. He wants to know if he's on the right track. He has only 3 funds and 5% of the total savings. So you're right about the fact that when you say he should technically consider, increasing his allocation to equity, but he should also consider other funds, shouldn't he?
Yes, he should consider other funds, and given his mindset, given his conservative approach to, he's been fearful of the market or equity in general, he should approach through different kind of fund, maybe, HDFC, Prudence, and 2, 3 other balanced fund, and that should be good enough. The other thing is accumulate amount, invest regularly, being able to average, because the moment you invest a lump sum, because he has sizable money lying elsewhere in fixed income. So the general approach will be that you have money lying elsewhere and you will move it to a balanced fund. That may not be a good approach. Stagger your investment, spread your investments over time. Maybe take it to 25, 30, 40% of your total exposure. And if you do it over the next 2, 3 years, you will be de-risking yourself. And I think you will start appreciating the benefit of it, because coming times, the return on fixed income will be 6, 7, 8%. That too, it will be taxable. Moving to a fixed income fund will actually will reduce your tax incidence, but it is unlikely to grow very dramatically. Only moving to equity, and in a calibrated way. And these equity, the balanced fund which I'm referring to, they are actually not balanced fund. They are aggressive allocation. They are normally about a quarter, 20, 30, 35% into fixed income. So you don't get a massive blow when the markets fall sharply. And that is important for an investor. These kind of funds are very useful for an investor like him. So he should approach it like this: increase his allocation to equity, approach it with balanced fund, make sure that you are not making a lump sum investment, and take it up to 30, 35, 40% gradually. And doing it over time, I think he will also be able to reconcile with, or he will not find it as risky as his understanding is right now.
Right, remember, if you have any other questions, feel free to get in touch with us. We understand that when starting off, like Dhirendra said, you will be a little uncomfortable with equity to start off small and then build your appetite. But it's so important that you invest in equity, especially if you have that 17-year horizon that you have. Like Dhirendra said, if you invest only in fixed income, your money will lose value. And that money will just be that much stronger if you include equity in your portfolio. You need to strengthen the equity portion of your portfolio. Dhirendra, Amit has written in. He has built an emergency fund, he says, of 5 lakh rupees as per our instruction. He wants to now invest that money in mutual funds so it does more, but still has the same liquidity of a savings bank account. Well, the good thing, Amit, is that all mutual funds are T+2, which means that if you put in a request to withdraw the money, you will get the money in 2 days. So they all have liquidity. The question is, what kind of mutual fund should you be using? Should he be using a mutual fund, for his emergency fund? And should that just be purely debt, because then he won't get the kind of returns he's hoping to get?
But still, if it's an emergency fund, the money should be accessible. And in fact, what you said, that T+2 is the way the transactions happen in fixed income fund. In fact, if you invest in a liquid fund, it is T+0. You get your money back in your account in about half an hour's time. Today, DSP, BlackRock, Reliance, and Birla, Sun Life, they are all offering an app which works seamlessly. You invest your money in a liquid fund, and the moment you request a redemption up to 2.5 lakh rupees in a day, you get the money in about half an hour's time. Sometimes it hits your bank early. So there is a so you can optimize your return, and I'm confident that the liquid fund will always generate more return than your savings bank account. I think it will be very useful for Mr. Joshi, our earlier question we took, that he also has money lying in his emergency fund lying in the savings bank account. It is almost like money lying in the savings bank account and accessible anytime. And maybe you need to, if you have 5 lakh rupees lying as emergency fund, or you have earmarked or allocated as one, you can segregate a part of the emergency fund as absolute emergency and a staggered emergency. The money which should be accessible in 2-3 days time, and that money can well find its way into a short-term bond fund, can earn little more, and maybe you don't have that emergency, and it can well turn out to be a long-term investment. So definitely it has to be, your emergency fund has to be parked in, has to be kept either in your locker or in your bank account or in a fixed income fund which is not subject to market risk of any substantial kind.
Not subject to market risk, and there's a reason why we say that, because if the emergency for which you've set aside this money suddenly occurs and you need to pull the money out, it shouldn't be coinciding with a time when the market has done badly on that one particular day or that one particular week, because then you'll be forced to take out the money when the market is down and you lose a lot of that value. Now, if, for example, you're investing for the long term, which is what we say, well, you have 10 years of a horizon, then it doesn't matter, and you're not forced to pull the money out on a day that the market is doing badly, which is why your emergency fund, like Dhirendra said, should not be in a pure equity fund. And, of course, the debt funds that we've recommended for this year is on your screen right now. Feel free to get in touch with us if you need any more help. 48-year-old Gigi George has written in. He plans to retire in a year, and he wants a regular monthly income post-retirement. He has 50% of his money in fixed deposits, 25% in mutual funds, and 25% in direct equity. Now, he has the Tata balanced, SBI blue chip. How should he go about his investments? So he seems to have thought this through, Dhirendra. 50% fixed deposits, 25% mutual funds, and those are largely balanced funds, and 25% direct equity. Is that a good way to go?
With 50% of his money in fixed deposit and 25% in balanced fund and 25% in direct equity, good that he has appreciated that he needs, allocation to equity to protect the worth of his capital. But I think the simple formula which one needs is, you must have money in fixed income to the extent that it can support your regular income requirement or regular income needs. So if his need is completely getting fulfilled by the fixed deposit and the returns generated by it, he should only invest to the extent that it fulfills that. Don't invest beyond that. So that way you will be reasonably assured. There is another way of achieving this goal. The other way of doing it is that, if you're working on a very tight capital budget and you want to really optimize your return, then maybe, just keep 3 years of income need as you're about plan to retire in a year's time, put your 3 years income need in a fixed income fund and start withdrawing and consuming from that. And keep rest of your assets in a conservative way, a set of balanced funds and maybe aggressive equity allocation or even a conservative equity allocation, but you're not withdrawing that money from that periodically. Only 2-3 years from now, you start supplementing your, you again take, every 2-3 years, allow your investments to grow, and whatever surplus you are able to generate, take that money out, put it in fixed income once again, or replenish your fixed income which you are consuming. So you will be saved from anxiety of, you're depleting your capital because you are doing it at regular periodicity and you have actually created that consumption bucket in fixed income fund. And you will also not get nervous about your growth allocation. And that way your money will get an opportunity and it will not be dependent on your, you are unlikely to hurt your interest by withdrawing your money at an inopportune time from equity, which often can happen. So these are broadly two approaches. If you have enough money, put money in fixed income to the extent that can support your income needs, rest in growth-oriented conservative investment. Other is, if you have limited capital, then maybe 2-3 years of income need in an income fund or in a fixed income investment, which you start consuming periodically without any anxiety, and remaining in conservative investments.
All right, that's the advice you're getting right now. We're going to take a quick break, but a quick recap of what we've learned. Don't leave your savings in a bank account. Invest in equity if you have a long-term horizon, and long-term qualifies as anything upwards of 7 years. We'll take a quick break. On the other side, we'll do our product review of the Birla Sun Life Dynamic Bond Fund. Don't go anywhere. Welcome back. You're watching Investors Guide. Thank you for staying with us. Let's take a look at our product review this week. It's the Birla Sun Life Dynamic Bond. Thanks, Ray. This week we take a look at a debt fund, the Birla Sun Life Dynamic Bond Fund, with a 4-star rating on value research. This fund has had an impressive return over the long term. Let's closely take a look at its performance in the last 5 years. The red line is the fund and the blue line is a benchmark. You'll see that the fund has consistently performed better than its benchmark and category. The fund was at its best in the year 2014 with a return of 15%. While the fund has had a consistent performance within its category, the category overall, however, ranked very poor in recent years. In the last 1 year alone, the fund gave a return of 12%, while the rest of the peers in the category performed much better. Recent performance of the fund, including its category, however, has not been very impressive. In the last 1 month, the fund's performance has spiraled down to a negative 3%. Within its category, however, the fund is one of the best performers. Is this a fund that you should invest in, or should you avoid the category altogether? Let's find out. With that, it's back to you, Faye. Dhananjay Joshi has written in. He said, because of some wrong advice, he invested a large sum of money in the Birla Sun Life Dynamic Bond Fund. Post the monetary policy, he suffered a substantial loss of 5 to 7%. He wants to know what he should do now. Should he pull out or remain invested? Now, here's the thing, the dynamic. This particular fund was part of your recommendation of funds for 2017 for conservative investors. Now, given recent experience that we've had, where everybody was expecting a certain thing and that didn't come from our, from the RBI, what happens to investors like Dhananjay Joshi who have lost money?
His case is very disappointing that he invested few days before the monetary policy announcement, when most of these funds, actually the best ones, actually took the biggest hit. I would say not much can be done about it. It might take 5 to 6 months to recover his capital. At the same time, I feel that most investors, the kind of investors who invest in mutual fund and the kind of investors for whom we suggest that they should be investing in fixed income funds, whether, of course, all mutual funds, all fixed income funds, dynamic bond funds, were met with a surprise that not only has the RBI changed its view, did not do any rate cut, but it completely changed its view that it is unlikely to do so. So this was a big change in the stance, and everybody was caught by surprise. this is among the best performing dynamic bond funds.
What is your star rating for the Birla Sun Life Dynamic Bond Fund? Where would you rate it for Investors Guide?
I think, looking at 10-year return, despite this big decline, looking at 1-year return, this fund is among the best performing ones. Yes, every fund was caught by surprise with this RBI move. It's bad luck for anybody who invested just before the monetary policy. It also is a lesson that, investors who are completely unnerved by this thing, they should not be investing. One can do without investing in these kind of funds. Even in the fixed income universe, you have the liquid fund, ultra short-term bond fund, short-term bond fund. So I would give it a 5-star rating for a dynamic bond fund. Look at the 10-year return, best performing fund. Full market cycle, nearly 10% return, and last 1 year, despite this 4-5% blow, it is still, one should have earned 13.5%, which is not unimpressive. But yes, bad luck for anybody who invested a few days before the monetary policy.
All right. So among dynamic bond funds, this is a 5-star fund, but you should be aware of the fact that there are risks to take on even when you invest in a dynamic bond fund. It's not the same as a fixed deposit, irrespective of what your agent might have told you. One quick question. Ramanarayan has written in, he's retired, he's considering that the bank fixed deposit interests are going down so drastically. He wants to invest 4 lakh rupees in 3 or 4 mutual funds for 3 years, Dhirendra. He wants to know how he should go about doing this. Do you recommend that 3 or 4 years mutual fund? Would it be a balanced fund or a dynamic bond fund that you would recommend for him?
2 ways of looking at it. I think, dynamic bond fund, kind of experience that investors have. It might be, they might be in for a disappointment. And one thing which investors should always take note of or take a lesson from, not only this, we have been talking about this even in the context of equity funds, the small and mid-cap fund. Investors look at recent past performance and then try to ride that run. And when it looks very compelling, you are more likely to be very disappointed. And this is what we see here. This is what we might see in the small and mid-cap universe, where things look so racy. So I would say about the 2 ways of approaching this: optimizing a return on fixed income in retirement, have a small allocation to equity, remaining in conservative fixed income, so that you don't lose your sleep. The other way is that if you have regular needs, then you have no choice but to invest in guaranteed yielding or entirely fixed income investments, and that might turn out to be low return. Settle with it.
All right, so that's the advice, and that's largely the advice right through the show, that even if you're someone who's conservative and you have to now consider the fact that the interest rates on fixed deposits are going to come down, that there is a certain amount of volatility also right now in bond funds, you have to include equity into your portfolio. Even if it's a small amount, start with baby steps, but begin to use equity mutual funds in your portfolio until you get more confident and you're able to take on more risk. We're here to help you if you have any trouble at all. It's a wrap on Investors Guide. Thank you for watching. If you have any questions, you know how to get in touch with us. We'll be right here every week.